Walgreens Boots Alliance, ticker WBA, is currently trading at more than a 10-year low, trading at $28.84. Now, I did a video on WBA about 2 months ago looking into its financials and calculating its intrinsic value. But today I want to have a look at WBA's business structure and analyze whether their future plans may lead to this stock to grow in price. Now, when we jump to the monthly full, we can see that WBA is planning on implementing a brand new business model. They currently own more than 13,000 stores across the US, Latin America, and Europe, and the company operates stores where patients can get prescriptions filled and shop for general goods like food, beverages, cosmetics, etc. Now, Walgreens decided that they want their stores to offer more value than prescription fills and retails, especially in the world where e-commerce is becoming the standard. So they acquired VillageMD and CareCentric over the past few years. Now, acquiring these two companies will allow WBA to sell their patients subscriptions for their services. From this diagram here, we can assume that a patient will buy a subscription and they will be assigned a health advisor. The health advisor will check on the patient regularly and will assign them a personalized plan in time of sickness. The health advisor will schedule appointments, improving the customer's experience and engagement. Now, the idea of this model is that it will keep Walgreens patients on the hook. The patients will fill multiple needs through Walgreens' various services as they progress through care, not just fill a prescription and disappear until the next appointment. Now, the company has already established more than 200 such clinics early this year, and more are to come. Now, one quite big red flag with WBA is that they are more than $13 billion in debt. And this comes from them acquiring VillageMD and CareCentric, and as $13 billion is more than half of Walgreens Boots Alliance market cap, this is quite a red flag. Now, when we jump to my Interactive Brokers account, we can see that according to Morningstar, WBA's fair value is sitting at $48, which is very close to the intrinsic value we calculated in my previous WBA video. Now, looking at the dividends of WBA, we can see that their current payout ratio is sitting at negative 50.03%, which means that they are essentially going into debt when paying for dividends, which again is quite a red flag. Their dividend yield is sitting at 6.76% with an annual dividend of $1.91, a very decent dividend yield indeed. Now, when we jump to the Analysts Forecast tab and switch to annual, we can see that the earnings per share of WBA is expected to rise from 5.04 to about 6.71 by the end of 2027. WBA's net income is also expected to rise exponentially. Now, if we scroll further down, we can see that WBA's dividend per share is expected to slow down, and this is because of their very high debt and their negative payout ratio. Now, scrolling even further down, we can see that the company is expected to increase their revenue by almost 20% by the end of 2027 and decrease their net debt by the end of 2025. With that, if you enjoyed this short video, make sure to leave a like and consider subscribing if you want to see more videos like this. Also, make sure to go watch the old WBA video if you want to see how I calculated the intrinsic value of the company.